Hey guys, welcome back. In today's video, we are talking about how Adam Aron was right, how shorts are trying to find shares, the crazy squeeze, and many more in this video. First, we take a look at this, the AMC recent trend. The short selling information, so the latest short interest is 52.76 million, so 14.04% of the outstanding shares have been sold short. Short interest has decreased by 7.73% from the previous month. This decline in short interest suggests some short sellers may be closing out their positions. And so what we can see is that the recent decrease in short interest could signal reduced pessimism about AMC's prospects. And now, this is something that we have to understand. Something that I've said on this channel for the longest time is that the data in which we are given for the short interest is, of course, at the end of the day, self-reported. This means that it is not 100% of the truth. And when we do see that the short interest has gone down, what we can tell is that maybe the real shares have, of course, gone down. So for the ones that are shorting the real shares of AMC, we're seeing a decrease by 7.73. But this doesn't in no way relate to all the synthetic shares that we have talked about in the past. But when you disregard the synthetic shares for a moment and you just take a look at the real shares, we also have to understand is that what we have seen in the past of understanding how they report different data for, of course, the reasoning of not actually showing how much they're shorting, this could be what we are seeing. So whilst we are seeing short interest go down by 7.73, remember it could be going down from what we've talked about in the past, from 800% to 700%. And it's not actually going from 20 to 13%. And so this is something that we obviously have to understand. And now there's a big, obviously, reason for this. One of the things, obviously, is, so you're telling me AMC paid off 25 million, did a small offering of 5 million shares, and we booped up recently. Almost like our drop from 2021 in price with no offerings, and our move up recently for offering means AA was right. Pay that debt down and continue to save on interest payments. So there's multiple reasons for why I want to quickly mention this. Now, the first thing is understanding about how short interest is going down. We're seeing AMC improve drastically in terms of fundamentals. That itself does kill the short thesis. This itself does attract new investors, hence why we're seeing some short positionings obviously closing out. But it's also talking about how Adam Aron was right. Now, one of the things that Adam Aron have always said was talking about how improving AMC fundamentally, making AMC a profitable company, making AMC able to profit a lot more than it is now, that's the ultimate way for the end goal. And that's exactly what we are seeing here. A lot of people are obviously saying that Adam Aron should go up to the SEC, Adam Aron should go up to, whatever regulation it is, to obviously get all of this sorted out. Now, again, I also do agree with this statement, but something that we have seen is that the regulations tend to help the institutions and not the retail. Now, then it comes down to possibly one of the only way for the squeeze to happen, which is for AMC to stay alive and AMC to improve, and that will trigger the squeeze, because by allowing AMC to stay alive and not in bankruptcy, shorts can't get out, and shorts will have to continuously paying money every single day to continuously financing their short positions, create more synthetics, which will obviously end up for a squeeze of AMC when they run out of cash. And so by AA doing what he has done, clearly right now, so far, it has seemed like it's the right move. And that's what we want to see for AMC's management, for AMC's whole kind of fundamental move to be going the way it is. Another thing we can see is how right now AMC is mirroring the movements of its peers in the industry. Some of the things we've talked about was obviously how, we're seeing Cinemark go up, we're seeing IMAX go down. And the reason for that is because the industry is expecting investors, is expecting improvement. We're seeing how the earnings turned out. But when we looked at AMC wasn't going up. And there's a clear reason why. So right now we're seeing this mirroring of the movement. So we're seeing the real movement. But one thing I want to quickly clarify, and again, I see this user has said, after Cinemark has a epic run up, now they can top Cinemark and pair it with AMC to push it lower. So even though we're seeing it mirroring the movement, which firstly confirms our thesis that the industry is seeing improvements, that the industry is seeing capital, but the reasoning for why they're doing this is so that they can actually push AMC down further. And so you can see behind almost every intention in the market for AMC, it seems like it's always negative. It seems like there's nothing they do that is actually positive and supposed to aid the movement of AMC. Now ask yourself this, and this is something that I always say. why would they be constantly trying to make bad of AMC if they are not affected by the movement of AMC? Why would they feel the need to push every other stock in the industry up but AMC down if they aren't actually hurt by AMC's price going up? And so this is why I said there are so many clues that allows us to understand that shorts are still in this play. They have never covered, they are always trapped and always will be trapped until they either squeeze or AMC goes bankrupt. Now, like we talked about with the way AMC is improving fundamentally with how they're managing all their debt, how they're managing the overall structures, their business structures, we're seeing how AMC is going to stay alive. And so if AMC isn't going bankrupt, then the institutions will go bankrupt. And that likely is what we're going to be seeing. And that's why they always feel the need to suppress AMC. You can also see this 0% cost to borrow fee. Someone wants us to short badly. Smells like desperation. So in our yesterday's video and even today, what we're seeing right now is the fee for AMC to be at 0% for 3.2 million shares. Now, the very fact, and this is what we talked about earlier, one of the things that will crush the shorts is that they're paying money every single day to finance their short positions. Now, with the fee at 0%, it obviously means they don't actually have to pay money. And so what we can get from this is firstly, what we've talked about for the longest of time in terms of how we're eating into the cash is obviously correct, to the point where they are right now showing signs that they are low on capital, that they are low on cash, hence why we're seeing this fee go to 0%. But it's also understanding the fact they're trying to obviously create an incentive for more people to short on their position. And you can see what we talked about earlier in terms of about how AMC, as long as it doesn't get bankrupt, they can't cover their shares, but it will cost them money to obviously finance the shorts, and that's why we see it at 0%. Another thing, fascinating how market makers can always find totally real sellers to match when big volume comes in to push price up. But the moment that the buyer slows down, those market makers can't find anyone to match the seller, so the price plummets on a tiny fraction of the volume up. So I would recommend you guys obviously go take a look at this for yourself, and you guys can spot the same thing. But when you take a look at AMC and you can understand, and now this is anyone who's traded or with a basic understanding of economics understand, is that obviously when we do see the volume go up, it means there's a high demand, which would of course cause the price to go up. But what we also see is that you can see the volume it takes for AMC to go to this price, but then you can see the volume it takes for AMC to fall down, and the ratio is completely different. So this means that it costs around, and again, this is for a example sake, there's not the actual ratio, but what we can be looking at as an example is it takes 5 times the amount of buyers to push the price up, but it only takes 1/5 of that to actually get the price down. And that's the difficulty that we are facing in this market. And that's what we talked about with understanding how AMC is constantly suppressed, how these institutions, how the market makers are always trying to push the price down. Now, let's talk about this. Call me crazy or dumb, but AMC above 4A will send the price to $20. They could hit $100 in a crazy squeeze. Now, I want to quickly talk about this. Technical analysis is something that we, of course, talk about on this channel every so often. And so there are some things I want to talk about. First is understanding this. Now, the first thing I want to mention is talking about crazy squeeze. So the word crazy squeeze and it has $100, I don't think that these two belong in a sentence. Now, I have talked about this French AMC ape person. I'm no mean bashing what this guy is saying. However, in my opinion, I do think that a crazy squeeze, or let alone just even a squeeze for AMC, will be way up in the thousands, if not tens of thousands of dollars price range for AMC. Now, I do believe that if AMC were to go up to $100 in a few days, that will still be a crazy movement, because it's still regardless going up a 20x, 30x, etc. But I don't think that it's something of a crazy squeeze. I think that it has to go up even higher than that for us to actually be understanding that it's a crazy squeeze. But also with the technical analysis, this understanding is that there are a lot of short sellers who have built up their positions, around this area, around the $4.50, around the $5 and the $6 area that we've talked about in the past. And so if we are able to see AMC go, over these areas, what we are seeing is the pressure that we've talked about in the past. Now, like we've seen, with the 0% borrow fee, it shows that shorts are lacking capital. It shows that shorts are lacking liquidity. So if we are able to get into a position where their margin requirements aren't able to obviously fit on any longer and that they are in need of covering these positions, then that is something that we could be seeing. And remember, it's a domino effect. It will take one big firm to cover their positions, which will force all the other firms to cover their positions as well. And this is why, when we take a look at the reverse repo, 238 billion, like I said, it's fluctuating. Don't worry that it's at 238. What we have to understand is by December, what is it going to be? By the January, what is it going to be? When is it going to go to zero? That's when it's important. Anyway, guys, thanks for watching. I'll catch you guys next time.